Most people think the stock market is just one thing, but they are completely wrong, and this mistake is costing them money every single day. But did you know there are actually 10 completely different types of stock markets, each one working in a completely different way? By the end of this video, you will know exactly which one can grow your money the fastest. Let's get into it. Stock exchange. A stock exchange is the organized marketplace where buyers and sellers come together to trade shares of publicly listed companies, providing the regulated infrastructure that makes it possible for millions of investors to buy and sell ownership stakes in businesses throughout every trading day. The New York Stock Exchange, founded in 1792 and located on Wall Street in Manhattan, is the largest stock exchange in the world by total market capitalization, listing thousands of companies, including the most valuable corporations on Earth, and facilitating trillions of dollars of trading activity annually. NASDAQ, the second largest exchange in the United States, pioneered electronic trading and became the preferred listing venue for technology companies, hosting giants including Apple, Microsoft, Amazon, Google, and Meta, whose combined valuations represent a significant fraction of global economic output. Stock exchanges provide crucial functions beyond simply matching buyers and sellers. They establish listing requirements that companies must meet to be traded, enforce disclosure obligations that ensure investors receive accurate information, and provide price discovery mechanisms that establish the fair market value of securities through continuous competitive trading. The trading hours of major stock exchanges, typically 6.5 hours on weekdays during business hours in their local time zones, define the windows when prices are actively formed through live trading, with after-hours trading available, but typically featuring lower liquidity and wider price spreads than regular market hours. Bond market. The bond market is where debt securities are issued and traded, allowing governments, corporations, and other entities to borrow money from investors by issuing bonds that promise regular interest payments and return of principal at maturity. The U.S. Treasury bond market is the largest and most liquid financial market in the world, with outstanding Treasury debt exceeding $30 trillion. These government securities serve as the benchmark against which all other interest rates are measured and as the primary safe haven asset for global investors during periods of financial stress. Corporate bonds allow companies to raise debt financing from the broader investment market rather than exclusively from banks, offering higher interest rates than government bonds in exchange for the additional credit risk that the borrowing company might fail to make promised payments. Bond prices move inversely to interest rates. When interest rates rise, existing bonds paying lower fixed rates become less valuable and their prices fall, while when rates fall, existing bonds paying higher rates become more valuable and their prices rise, creating a mathematical relationship that bond investors must understand to manage their portfolios effectively. The bond market is significantly larger than the stock market in total outstanding value, with global bond markets exceeding $100 trillion compared to approximately $100 trillion for global equity markets, making it the foundational market that influences the cost of borrowing for every participant in the global economy. Forex Market. The foreign exchange market, universally known as Forex or FX, is the global marketplace where currencies are bought and sold against each other, operating continuously 24 hours a day, 5 days a week across financial centers in Tokyo, London, New York, and Sydney as the world's trading day moves through time zones. With daily trading volume exceeding $7 trillion, the Forex market is by far the largest financial market in the world, dwarfing the stock market, bond market, and all other financial markets combined, with this enormous liquidity making it possible to execute large trades without significantly moving prices. Currency pairs are the fundamental trading instruments of the Forex market, the exchange rate between two currencies expressed as how much of one currency is needed to purchase one unit of another, with major pairs including EUR-USD, USD-JPY, and GBP-USD accounting for the majority of daily trading volume. Corporations use the Forex market to manage currency risk inherent in international business. A U.S. company that sells products in Europe receives payment in euros that must be converted to dollars, and changes in the EUR-USD exchange rate directly affect the dollar value of those revenues. The Forex market is particularly challenging for individual investors because it is dominated by sophisticated institutional participants, including central banks, commercial banks, hedge funds, and multinational corporations, whose size, information advantages, and resources make consistent profitability extremely difficult for retail traders.
Commodity markets. Commodity markets facilitate the trading of raw materials and primary agricultural products: oil, natural gas, gold, silver, copper, wheat, corn, soybeans, coffee, and dozens of other physical goods that form the foundational inputs of the global economy. The Chicago Mercantile Exchange and the Intercontinental Exchange are the dominant global commodity trading venues, hosting futures and options contracts that allow producers, consumers, and speculators to trade standardized contracts representing specific quantities and qualities of commodities for delivery at specified future dates. Futures contracts are the primary instrument of commodity markets, binding agreements to buy or sell a specific quantity of a commodity at a predetermined price on a future delivery date, allowing oil producers to lock in selling prices months in advance and airlines to lock in fuel costs regardless of what spot prices do in the interim. Gold occupies a unique position in commodity markets as both an industrial metal and a monetary asset. Investors buy gold as a store of value, inflation hedge, and safe haven during financial crises, making gold price movements responsive to a complex combination of industrial demand, investment sentiment, currency movements, and geopolitical stress. The energy commodity complex, particularly crude oil and natural gas, has profound economic significance because energy costs affect virtually every other good and service in the economy, making oil price movements a leading indicator of inflationary pressure and economic activity that central banks and governments monitor closely.
Derivatives market. The derivatives market trades financial instruments whose value is derived from the performance of an underlying asset: stocks, bonds, currencies, commodities, or indices, allowing investors to hedge existing positions, speculate on price movements, and create complex risk management strategies impossible with direct asset ownership. Options contracts give the buyer the right but not the obligation to buy or sell an underlying asset at a specified price before a specified expiration date, providing powerful tools for limiting downside risk while maintaining upside exposure, or for generating income through premium collection strategies. Futures contracts obligate both buyer and seller to complete a transaction at a specified price and date, used by institutional investors to manage portfolio risk, by speculators to take leveraged positions on price movements, and by commodity producers and consumers to lock in future transaction prices with certainty. The notional value of the global derivatives market, measuring the total face value of all outstanding contracts, is estimated at hundreds of trillions of dollars, making it the largest financial market category in the world by this measure, though the actual economic exposure represented is significantly smaller than the notional figures suggest. Derivatives' complexity and leverage make them among the most risky instruments available to investors. The same leverage that amplifies gains in successful positions magnifies losses in unsuccessful ones, with the potential for losses exceeding initial investment, making derivatives unsuitable for inexperienced investors without deep understanding of risk management. Cryptocurrency market. The cryptocurrency market operates continuously without any central exchange or regulatory body, trading digital assets including Bitcoin, Ethereum, and thousands of alternative cryptocurrencies through a global network of exchanges, decentralized platforms, and peer-to-peer transactions. Bitcoin, launched in 2009 as the first practical implementation of blockchain technology, remains the dominant cryptocurrency by market capitalization, widely held as a store of value, with a fixed maximum supply of 21 million coins that its supporters argue protects against inflation that affects traditional currencies. Cryptocurrency exchanges, including Coinbase, Binance, and Kraken, provide the primary infrastructure for retail cryptocurrency trading, offering order books, price charts, custody services, and fiat currency on- and off-ramps that connect the traditional financial system with the cryptocurrency ecosystem. The extreme price volatility of cryptocurrency markets distinguishes them from traditional asset classes. Bitcoin has experienced multiple drawdowns exceeding 80% from peak prices, while also producing extraordinary gains during bull market periods, creating risk and return characteristics unlike any traditional investment. Decentralized finance, known as DeFi, represents the frontier of cryptocurrency market development, using smart contracts on blockchain platforms like Ethereum to recreate financial services, including lending, borrowing, trading, and yield generation, without any central institution or intermediary involved in the transaction.
ETF Market. Exchange-traded funds are investment vehicles that hold collections of assets, stocks, bonds, commodities, or other securities, and trade on stock exchanges, exactly like individual stocks, combining the diversification benefits of mutual funds with the intraday trading flexibility of stocks. The Vanguard S&P 500 ETF and the iShares Core S&P 500 ETF are among the most widely held investment vehicles in the world, providing instant diversification across 500 of the largest U.S. companies through a single purchase with expense ratios as low as 3 basis points, making professional quality diversified investing accessible to anyone. Sector ETFs allow investors to target specific areas of the economy, technology, healthcare, energy, financial services, without needing to research and select individual stocks within each sector, accessing the performance of an entire industry through a single diversified instrument. The tax efficiency of ETFs relative to mutual funds makes them particularly attractive for taxable investment accounts. The unique creation and redemption mechanism that ETFs use to manage investor flows typically generates fewer taxable capital gain distributions than actively managed mutual funds that must sell holdings when investors redeem shares. Thematic ETFs, targeting specific investment trends, artificial intelligence, clean energy, cybersecurity, genomics, have proliferated rapidly as the ETF structure has proven effective for providing investors with targeted exposure to long-term structural trends without the concentration risk of individual stock selection.
IPO Market. The initial public offering market is where private companies make the transition to public ownership, selling shares to the general public for the first time through a regulated process that raises capital for the company while providing early investors and founders with liquidity for their ownership stakes. The IPO process involves extensive preparation, financial audits, regulatory filings with the Securities and Exchange Commission, roadshows where company management presents to institutional investors, and price discovery processes through which investment banks determine the offering price based on investor demand. High-profile technology IPOs, including those of Google, Facebook, Alibaba, and Uber, generated enormous public interest interest in media coverage, making IPO investing appear glamorous, while the historical data shows that retail investors rarely access IPO shares at the offering price, typically buying in the secondary market after early institutional investors and insiders have already received preferential allocation. SPAC transactions, special acquisition purpose companies, emerged as an alternative pathway to public market listing. Blank check companies raise capital through their own IPOs with the intention of identifying and merging with private operating companies, providing a faster and more certain alternative to traditional IPO processes. Research consistently shows that IPO stocks as a category underperform the broader market over the years following their public offering. The excitement and media attention surrounding high-profile IPOs often results in initial overvaluation that eventually corrects as the company's actual operating results are measured against optimistic projections. Real estate investment market. The real estate investment market encompasses multiple pathways for investors to gain exposure to property values and rental income. From direct property ownership to publicly traded REITs, real estate crowdfunding platforms, and mortgage-backed securities. Direct real estate investment provides the maximum control and leverage, but requires the most active involvement. Investors must manage properties, handle tenant relationships, maintain buildings, and navigate local market conditions that vary dramatically between geographic markets. Publicly traded real estate investment trusts allow investors to access real estate income and appreciation through stock market transactions, buying and selling REIT shares with the same ease as any stock, while receiving the income distributions that REITs are legally required to distribute. The diversification potential of real estate investment relative to stocks and bonds has made it a standard component of sophisticated investment portfolios. Property values and rental income streams have historically shown low correlation with stock market performance, providing genuine portfolio risk reduction when combined with traditional financial assets. Commercial real estate investing, office buildings, retail centers, industrial warehouses, multifamily apartment complexes, and hospitality properties offers income characteristics and valuation dynamics distinct from residential real estate, with institutional investors allocating significant capital to commercial property as a core portfolio holding. Private equity markets. Private equity markets provide investment capital to companies that are not publicly listed on stock exchanges through venture capital funding for early-stage startups, growth equity for expanding businesses, and leveraged buyout transactions that take public companies private to restructure and improve their operations. Venture capital is the private equity category most visible to the general public, funding early-stage technology companies including Uber, Airbnb, and Stripe before they achieve the scale and financial maturity required for public market listing, with successful investments generating returns that far exceed public market alternatives. Leveraged buyout firms, including Blackstone, KKR, and Apollo, acquire established businesses using substantial debt financing, improving operational efficiency, reducing costs, and growing revenue before selling the improved business through a public offering or to another buyer, typically over a 3 to 7 year holding period. The illiquidity premium is the fundamental justification for private equity investment. Investors who accept that their capital will be locked up for years without the ability to sell receive higher expected returns than public market investors who maintain continuous liquidity, compensating for the inability to exit positions during the holding period. Access to private equity investment has historically been limited to large institutional investors and very wealthy individuals. Minimum investment requirements of millions of dollars, long lockup periods, and complex legal structures created significant barriers, though newer platforms are beginning to provide partial access to private equity strategies at lower minimums for qualified retail investors.
That covers 10 stock market types that can grow your money. If this video helped you understand something new, make sure you subscribe to ByteSimple right now, because next week we are breaking down 10 cryptocurrency types that changed finance forever. And trust me, you do not want to miss that one. Drop a comment below and tell us which stock market type are you most interested in. See you in the next one.